Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, June 2nd, 2026, and we're seeing quite a bit of movement across markets today with earnings surprises, labour market strength, and some notable geopolitical developments. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the standout story this morning is the incredible earnings performance we're seeing from individual companies. That's really driving significant moves. Hewlett Packard Enterprise absolutely crushed expectations. And we're talking about a 25% surge in the stock, which is pacing for its best day ever. They beat on earnings and raised guidance, which in this environment is exactly what investors want to see. Then you've got Victoria's Secret up 50%, yes, 50%, on turnaround-driven annual forecasts that have really caught the market's attention. What's interesting here is we're seeing this bifurcation where strong individual company performance is being rewarded dramatically, even as broader market sentiment remains somewhat cautious. On the labour front, we got April job openings data showing a surge to 7.6 million. The highest level in nearly 2 years, with professional services leading the way. That's a sign of labour market resilience that could have implications for Fed policy thinking. And then there's the Middle East situation creating some volatility, with US stocks initially dropping before recovering as traders digested the developments. Oil markets are particularly reactive right now, with Vittel warning about supply crunches that Europe and the US aren't adequately preparing for. While we're simultaneously hearing about prospects for a US Iran peace deal, ADNOC is planning new UAE pipeline infrastructure to bypass the Strait of Hormuz, which tells you how seriously energy companies are taking these geopolitical risks.
That HPE move is remarkable, and it speaks to how hungry the market is for companies that can deliver and raise guidance. What does this mean for traders and investors navigating these crosscurrents?
For traders, the key takeaway is that stock selection matters more than ever right now. We're in an environment where the rising tide isn't lifting all boats equally. You need to be positioned in companies with strong fundamentals and the ability to beat expectations. The HPE and Victoria's Secret moves show that when companies deliver, the market will reward them aggressively. On the labour market data, that 7.6 million in job openings is a double-edged sword. It shows economic strength, which is positive for corporate earnings, but it also means the Fed isn't going to be in any rush to cut rates if the labour market stays this tight. For oil-exposed positions, you need to watch the Middle East developments closely, because we're seeing real infrastructure responses like the ADNOC pipeline project, which suggests this isn't just short-term noise. The fact that gold is now replacing US Treasuries as the world's top reserve asset, according to the ECB, is a longer-term structural shift that speaks to diversification away from dollar-denominated assets. That's significant for portfolio construction going forward.
Let's talk technical levels. How are the major indices positioned right now?
Looking at the technicals, the S&P 100 is showing resilience, but we're at a critical juncture. We've got support around the 3,180 level, and as long as we hold above that, the bullish structure remains intact. Resistance is at 3,240, and we need to see a decisive break above that level with volume to confirm continuation. The index recovered from early losses today, which is constructive, but we need follow-through. For the Nasdaq, we're seeing the AI fervor Robert mentioned being weighed against geopolitical concerns. The tech-heavy index is holding the 18,500 support level, but we're watching 18,800 as the key resistance. The concentration in mega-cap tech means any rotation or profit-taking there has outsized effects. What's interesting is we're seeing some of that rotation into beaten down sectors when they deliver earnings surprises. The Dow Jones is actually showing relative strength, which makes sense given it's more value-oriented and less tech-concentrated. We're above 42,000 support with 42,400 as the next resistance level. The Dow's outperformance suggests investors are seeking safety in more established, dividend-paying names while maintaining equity exposure.
That selectivity is going to be key. Now let's turn to crypto because there's been quite a bit of turbulence in that space, Lizzie. What are you seeing in crypto markets heading into next week?
Robert, the crypto market is experiencing significant pressure, particularly Bitcoin, and the sentiment has turned decidedly bearish. Bitcoin is in what analysts are calling a distribution phase, with extreme fear gripping the market. The big catalyst was Strategy's historic sale of 32 BTC in late May, their first sale since 2022. Which has had a major psychological impact. We've also got Mt. Gox moving 739 million worth of Bitcoin from cold wallets as their deadline approaches, raising serious distribution concerns. The really striking data point is the record ETF outflows. We're talking $355 billion in outflows over 11 days, with the biggest single-day sell-off hitting 3.4 billion BIC. Bitcoin dropped to 7-week lows under $71,000, and that February low of $60,000 is back in play if we don't find support. For next week, I'm bearish on Bitcoin with a target range of $65,000 to $69,000. The key resistance is now at $71,000, which was previous support, and critical support sits at $65,000. If that breaks, we could see a retest of $60,000. Ethereum is showing relative strength though, which is interesting. Bitmain just purchased 52 million worth of ETH, showing institutional confidence, and analysts like Tom Lee are suggesting ETH's price hasn't yet reflected Ethereum's fundamental strength. Standard Chartered is even suggesting that Strategy's Bitcoin sale could mark the start of Ethereum outperformance. I'm cautiously optimistic on ETH for next week, neutral to bullish, and watching that ETH BTC ratio closely for confirmation of this outperformance thesis. Solana is caught in a paradox. There's 1 billion in ETF interest, but the price keeps falling. It's heavily correlated with the broader crypto weakness right now. I'd characterize Sol as bearish to neutral for next week, really dependent on whether Bitcoin can stabilize and whether we get clarity on those ETF launch timelines.
What's driving this divergence between institutional interest and price action, particularly with Solana?
It's a classic case of buy the rumor, sell the news dynamics, but in reverse with Solana, you've got this massive ETF interest. Institutions are clearly paying attention. Kalshi is planning Sol perpetuals following their Bitcoin approval, but the actual price action isn't reflecting that interest yet. Part of it is timing. ETF interest doesn't translate to price support until those products actually launch and start buying the underlying asset. Until then, it's just theoretical demand. The other factor is that all crypto assets are still highly correlated during periods of stress. When Bitcoin is selling off hard like we're seeing now, with those massive ETF outflows and the strategy sale creating fear, everything tends to move together regardless of individual fundamentals. For Solana specifically, investors are waiting for that ETF approval and launch to actually materialize. The institutional recognition is there, the infrastructure is being built, but the market wants to see actual flows before pricing it in. On the institutional versus retail positioning in Bitcoin, we're seeing a clear divergence. Retail sentiment has turned fearful. You can see that in the social metrics and the panic around the strategy sale, but institutional players are more nuanced. Yes, we had record ETF outflows, but firms like Strive added 2,500 Bitcoin last week to reach 19,000 BTC, while strategy was selling, so you've got some institutions selling and others buying the dip. The institutional thesis hasn't changed for many players. They view Bitcoin as a long-term treasury asset and portfolio diversifier. What we're seeing is more likely profit-taking after strong runs and some rebalancing, rather than a wholesale abandonment of the asset class. The volatility is down 56%, but analysts still expect up to 20% moves in Bitcoin, which means we're in a consolidation phase that could break either direction. For patient institutional capital, these pullbacks historically have been accumulation opportunities.
Well, that wraps up today's Morning Bell. We've covered significant earnings surprises driving individual stock performance, resilient labor market data that keeps the Fed's attention, geopolitical developments affecting energy markets, and notable turbulence in crypto with Bitcoin facing distribution pressure. While Ethereum shows relative strength, markets continue to reward strong execution and fundamentals while navigating macro uncertainty. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we continue tracking these developing stories. I'm Robert, along with Lizzie and Steve. Thanks for listening.